As an LP investor, have you ever wondered where other investors are putting their capital, what the trends might be, and what insights that you might be missing? In this episode of the Passive Income Playbook on the Best Ever CRE Show, we're going to dive deep into different LP investment trends from last year, data that can shape how you invest moving forward. I'm your host, Pascal Wagner, and today we're joined by Litan Yahav, co-founder of Visor, a platform that tracks over 18 billion in LP investments across over 3,500 LP investors and 600 different operators. And it's monitoring tons of different assets across real estate, private, public markets, and just generally alternative investments. So, in this episode, Litan's team has uncovered 4 major shifts in LP investing over the past year, but we might get into more. And if you're an LP looking for data-driven insights, how to optimize your investment strategy, this episode will be for you. So thank you for joining us. Welcome, Litan.
I'm so excited to be here, Pascal. This is a great setup you have. Thanks for having me.
Yeah, excited to have you here. So you just flew in from Washington, D.C. I also just hung out with you at the Best Ever conference a couple weeks ago. I would love to kind of just, maybe for the audience who hasn't been to Best Ever, I'd love to get maybe your take on what you took away from this year's conference.
Yeah, we had a fun time at Best Ever a few weeks ago. This was my 3rd year, I think, out there. Every year is a different layout. This is really interesting because also got to meet a lot of friends in the industry, LPs, GPs, vendors, and across the board. My main sort of takeaway from this was there were a lot of capital raisers at this Best Ever conference, more than previous years, I think. A lot of vendors, overall good audience, and just interesting conversations about where the market has been and where it's going. No one really knows, right? But everyone's speculating.
Yeah.
And it's just interesting conversation and just fun to be out at Best Ever. I like Salt Lake.
Totally. Yeah, I think it was in, although I didn't personally go the last 2 years, I heard that maybe the sentiment or the morale was maybe a little bit lower, just due to the craziness we've had the last couple of years in the commercial real estate market.
Yeah, I mean, there's so many reasons it could be. Obviously, one of them is the fact, I mean, when you think, so when I got into passive investing, everyone was just investing as an LP in real estate syndications, predominantly multifamily, value-add type plays. And I feel like that has sort of become a bad word in LP investing. I don't think it's okay that it's become, it just has, because a lot of people got burned, lost money. And so when you think about these GP-LP events, the biggest asset class is multifamily real estate. People aren't investing as much as they used to, and that might be affecting it to some extent.
Yeah, I imagine. But as we all know, when the market's down, that's usually when you want to make big bolder bets.
100%.
So cool. What I would love to do is frame the conversation a little bit for our listeners. The Passive Income Playbook targets LPs or prospective LPs who want to learn more, take away. I'd love to start out with a little bit of the story of selling your company, getting into LP investments, what problems you encountered that led to Visor. And then after we kind of cover the basics so people know who they're listening to, dive more into the trends and the data and just maybe like the unique perspective that you have from aggregating so much data, which is uncommon, right? That's why I wanted to have you on the show to share a lot of those types of insights. So to start, I don't think we need to necessarily go into the details of exactly what the company was, unless it's relevant, but I would love to kind of talk about that story, that transition where you found yourself selling the company and getting into LP investing. Why? What problems were you trying to solve? Let's go there.
Yeah. So first of all, my background is not in real estate and it's not in finance. We sold a company in the crazy industry, the diamond industry. We did hardware, software, not relevant for the conversation, but we made some money. This was 10 years ago, 2015.
Wow, it's 2015, so it's 10 years ago.
Yeah, 10 years ago. Shit, we're old. But anyway, so sold that company, made some money, And me and my co-founder, so also I'm from Israel, and it's important for a conversation because in Israel, when you encounter some sort of windfall or excess capital, you look for alternative ways to invest it. And everyone knows a guy who does real estate abroad, and so it's like, all right, so I have this capital. I'm set because retirement is like mandatory in Israel. Everyone has the equivalent of a 401k. And so I knew a guy, and we started to ask, all right, what do we do? Like, do you have any ideas where we should invest? And a guy knows a guy, a friend of a friend. And we started to deploy capital, beginning into a couple single family homes in the U.S. And at the same time, in this thing we just learned about called a multifamily real estate syndication, where you pull capital together and you invest together, and this other general partner who manages the show, and you get a cut. And a year goes in, and these single families are a total mess, and not getting the returns we thought, and just getting bombarded by phone calls and emails from the property management firm and all that stuff. And this multifamily syndication is just cash flowing and generating returns and not doing anything. It's like, oh my God, this is amazing. We should just do more of this. And retrospect, these were amazing times to do it. Everyone who threw a pen on Google Maps and could make a deal pencil in because the interest rates were zero. And so a lot of operators spent a spread out, so it was easy to find deals. And we started to deploy capital, $50,000, $100,000 checks to different real estate plays in the US and Europe. And then that evolved. And those passive investments, these are good problems to have, right? But they just started to become active. And I joke about it. We get an email from a GP, and I'd be like, holy crap, who is this person? And when did we invest with them? And again, good problems, but... So we said, all right, we need a system in place, me and my co-founder at that point, to track and manage our own stuff. So we hired an engineer, we built a platform to serve essentially as our sort of administrative family office, basically a personal assistant to gather everything, analyze everything. And then while we're doing that, a bunch of people around us wanted as well, and that evolved into Advisor. But that's sort of like the background of how we got into this passive investing world. And there's a lot of points throughout the journey that we learned, better define how we select operators, how we select deals, and perfect our strategy while building this portfolio that became more complex than we imagined and became more active, and we wanted to bring it back to the passive world.
So I would love to dive into maybe some nuances, right? I imagine every LP investor ends up making their own spreadsheets or trying to figure out how to track their own investments, and it's hard to keep up with. And I imagine you had some sort of initial vision that shifted as you learned, or you had made a bet and no one cared about that. And what would be some of those things as you were building this out?
So are you talking from the investment standpoint or from the tracking of it?
Tracking. I would love to do the tracking.
So when you invest in these asset classes that are alternative, not necessarily audited like a public investment would be or a public ticker, everything is really unique to the structure of the investment you make and the terms of that specific operator dictated. And the variant between each fund is so crazy, and the way they track a multifamily value add deal and a development deal or a private lending fund or a larger private equity that has capital calls that are a good thing, and then in real estate syndication, a capital call is a bad thing. And so how do you put that all into one? And then you also have leverage into the whole play, and do creative financing and life. It just suddenly the spreadsheet that you built, which is great. I love spreadsheets. I'm a spreadsheet guy, but when you start to build out more and more line items, I mean the plug number, I'd say 8 or 10 private investments. That's when it becomes complicated, and that's when things start to break, and that's when we need to standardize and structure the way it's processed. Because also the parameters on each of these, there's metrics. There's the cash on cash, and then there's the pref, and then that's not necessarily the same thing. Many people think if you get a preferred return of 7%, that's also going to be your cash on cash return on an annual basis. Totally different things. I mean, we can dive into the nitty gritty of spreadsheets, but or just calculating and tracking investments. I don't know how interesting it is, but there are a lot of nuances. Like IRR. I think IRR is the most important metric of them all in any investment. It's the only thing that takes the cash flow and the appreciation into account. But how do you calculate an IRR? Because an IRR is calculated based on cash flows when there's no cash flow. Like, how do you take account for your position? You invest a $50,000 check. Like, well, I don't know, what do you do? Like, $50,000 check, 5 years in. Do you change the value of your position? Do you increase it? Do you keep it the same? Do you even touch it? Who cares? I don't know.
Yeah, interesting. I think at least when I look at my investments, I track all of my stuff in QuickBooks. I have a personal P&L and balance sheet, and then I also have a holding company P&L and balance sheet that I make investments out of.
Okay.
That's my primary investment vehicle, and I have it in, it's not owned by me. It's in, a asset protection trust, which if you're getting deeper into these types of things, I mean, I'm not making financial recommendations, but there's many reasons why to do those things. And so, yeah, I basically leave the value equivalent to what I've invested.
So the cost.
But we talk about how we keep track of it, when each year my tax accountant, we get the K1s from the investments, and that adds a new, what we call a share of liability. So I get all this depreciation from the investment. And so when I look at the balance sheet of where all my real estate investments are, it's actually much lower than what I really think it to be, just the way that the tax influences how it plays in the balance sheet.
Yeah,
so hard to track.
Well, because when you combine both net worth and taxes, they're two totally separate ways to look at your wealth. Like, if I want to liquidate all my positions today, there's a value to put on them. And that is a very different value than from a tax perspective. Because like you mentioned, a $50,000 position might be worth zero on paper, but it's still $50,000 or even more, because when that exits eventually, I'm going to get a payout. I mean, and it's just, I think it's an important thing to be aware of. Like, the worst thing that happened in asset management and wealth management is surprises. If you can minimize surprises as much as possible, you're going to be in a better place. They're good at surprises and they're bad surprises. Bad surprises are when you commit to invest $1 million or $100,000 in a fund. You put down 20 because that's what it's called, and then you forget you still committed another 80, and then something that comes around and crap, I don't have it. I have to go scramble to find 80,000. Or the other way around, where suddenly you get a windfall of an exit that you forgot you were even invested in. Now, I don't want that money sitting in my bank. I need to find an alternative. So, like, if you're surprised, it's usually, it's just a setup for bad decisions.
When you started investing after the exit, give us a little bit of a breakdown of all the different types of things you invested into, and maybe like what was your thinking or rationale behind each of those? I'm picturing Litan sitting in halfway across the world, trying to decide. You must have had some affiliation to the U.S. to move your money there instead of keeping it invested locally. Maybe this concept is less popular in the Middle East. Walk us through that mindset.
Yeah, well, first of all, we were clueless. We did know that we wanted to achieve some sort of alpha, and we thought we could make better decisions than a financial advisor. We'll probably put in some sort of like general account and just have it grow. Usually, I don't believe that most of these people beat the market in the public markets, and the private markets that they invest in is usually like the Blackstones of the world, and I wanted the smaller, more riskier investments. So anyways, we just decided, all right, I want to create alpha. I wanted to make some investments that, number one, are diversified outside the public markets. Number two, outside of my currency, which is shekels in Israel. And at the beginning, I invested, in the U.S. I'm American, and so it was easier for me to invest here. In Europe, across Europe. I also, or let's say in Europe on euro, which is one currency, and I also made one investment in Poland in zloty, which was a good investment on paper, but I didn't make close to what I did on paper because the exchange rate between zloty and shekel went so down. I needed cap. Anyway, it's a whole mess. It's really interesting because you look at Americans, we on our platform we track a lot of people, a lot of investments. It's extremely rare, like sub 1%, for someone to have a holding abroad, like in a different currency. It's so mind blowing when you think of it as a foreigner who's in I mean, you want some sort of diversification. Here, when you hear about diversification, it's usually because they want like a second residency, not because they're thinking about diversifying their portfolio. So yeah, really interesting. So anyway, so we started to deploy. At the beginning, it was only with people we know and trust, like personal level. So it's usually small operators who, again, we know that they're not going to screw us over, they're not going to lie to us, they're not going to steal from us. And then the asset class itself didn't really matter to us as long as the risk return made sense. So if I'm investing in someone who does development, which is higher risk, I'm expecting higher returns than someone who's doing a multifamily value added play. Versus if I'm in a lending fund, the risk is lower, and so I understand that the return is also going to be lower than on those other plays. And so I wasn't looking to diversify the asset class, just finding good operators and then make sure the numbers from a risk return standpoint work for me.
Were you focused on like, hey, I want at least X percent in cash flow. I need to meet a cash flow number, or I'm mostly just trying to get the highest return. The cash flow doesn't matter to me. How did you think about that, or did you even think about that?
Cash flow is good. I didn't think about it. I wasn't smart enough at that point to think about planning. Or how much do I need of cash flow to cover my monthly expense? I mean, we didn't think about it in those terms. A lot of people do and should. Now I do more. Although a lot of times when you think about taking higher risks and higher returns, that usually also comes on account of cash flow. And I'm still in wealth creation mode. In wealth management, there's wealth creation and preservation. Creation is usually more aggressive, taking more risks, more returns. Preservation is a lot more conservative, low single digits. That's enough. So because I'm in that aggressive phase and I want those high returns, the cash flow usually is secondary.
You mentioned it's kind of crazy for someone in the U.S. to invest in a foreign holding. I think anytime I hear about that in any of these circles, it's usually like, we're gonna invest in some resort in Belize, or we're giving loans out to other country or buying property in Mexico. And I think, at least from my perspective, they may or may not be good investments. You have to look at each investment on its own. But in general, I think the fear that I have is that you are now investing outside the U.S. jurisdiction, where it's hard enough to go after anyone if things go sideways, where there's a certain level of a different way to say it would be, if I'm investing in Mexico, I've thought about buying a little rental property in Mexico, and the idea that you don't have as much control there. A cartel could, come through and wreck something, or you have the exchange rate problems. Are those not similar fears that, you as a foreigner have investing in the U.S., or is it more considered that the U.S. is maybe a holy grail market, or what is that viewed as?
So I think it's a great question, and I think my perspective is always that of a passive investor. So when I look at these different markets, it's all about who is the operator I'm investing with. Because if I'm investing in Mexico, for example, it won't be me going to buy a rental property. It will be me find someone who I trust who's doing real estate in Mexico. And I'm sure anyone who does real estate in Mexico on a day-to-day basis knows how to deal with the local markets, local cartels, and all that stuff. And so for me, again, once I check off that first most important aspect of investing, which is the GP, the operator, everything else is I don't really care that much, because the same thing can happen in, I'm invested in Albuquerque, New Mexico. Never stepped there in my life. I don't even know how I don't know how anything works in New Mexico. It's for me, same currency, it's US, whatever. I'm not going to go there and take possession of a property. I don't know anyone there. So it's about, for me, again, trusting the people I invest with.
So as someone who just sold a company and probably new to asset allocation, maybe not.
You give me too much credit.
But how did you go about finding people? You mentioned people I knew or people I Now, I imagine, I mean, when I first got into the space, I didn't know any operators. And it was mostly through people in GoBundance and talked about, where are they investing? Who have they had success with? Is it a similar type of process, or do you have unique connections, or yeah?
So again, in Israel, it's crazy. It's like everyone who has, even a small, like, has $50,000 aside knows a guy who does real estate abroad. Like, knows a GP. It's really crazy. It's like everyone knows someone in Israel who does that. And at the beginning, when I started investing, was investing with these GPs, Israelis, who either are on the ground operators here, or I understood this later in the game because I didn't understand this at the beginning. They're capital raisers, or they partner with JVs with local operators in the U.S. And because I only chose to invest with people I trust, there's a limited circle of how many people I can find who I trust, because I don't know a lot of people that I don't trust in Israel, so that I won't invest with. And that's actually why I joined GoBundance. I joined GoBundance, about 5 years ago, to do that, to find people I can trust, to invest with. Because it seemed really stupid. Like, why am I investing with an Israeli GP capital raiser if I can reach the source directly? Why would I want to go through someone else? The only reason is because they create a trust level. But if I can create that trust directly, then I'll do that. That has its own issues, and we saw some good abundance, right? But I felt like that was like the next level for me to dive deeper into connecting directly with the local market instead of through a third party. It also, throughout the whole period of investing, you also understand terminology that I didn't understand at the beginning. People say the word sponsor. What is that even? What is that? I didn't. And then there's a sponsor. There's an operator. Sometimes it's the same person. Sometimes it's two people. Sometimes there's a capital raiser on top of that. Sometimes it's like just understanding that I don't even know how to define that title stack. Was like a learning curve as well. And I wanted to invest with the operator, not with the capital raiser, who sometimes didn't even tell me who the operator was. Now thinking about it, retrospect, that's totally crazy. Like, why would you? I'm investing with you because you get me better terms. Not because, you're shady and not telling me who the person you're actually investing with is. Anyway, yeah, so that was like the way it started.
I would love to, I'm just going to put you on the spot. For those listening, if they're newer, walk through some of those.
What, the names? The terminology?
Yeah.
Well, when you look at the private equity space in general, and I put this as private equity because it's really important to understand that we both come from a tech background. And in our background, when you say PE or private equity, it's like these are growth funds who go buy companies before IPO. That's private equity. But when you look at, guys in GoBundance, everyone has a private equity firm because a real estate syndication is also a type of private equity.
So is venture capital.
So 100%.
Which is early stage.
100%.
Before the growth equity. Yeah.
It's like, going back to the tracking question, asset allocation, it's funny, when we, 10 years ago when we built this spreadsheet, we created our own asset classes. And these are still the basic asset classes. Advisor, we've tweaked and added custom classes and different stuff, but it's funny how when you look back at it, how crazy those names for asset classes actually are. Because when you look at it today, I see it, there are three main types. There's cash, there's publics, and there's privates. And then within privates and publics, each of them has equity and debt, right? Public equity and public debt, bonds versus equities. Private, same thing, private equity, private debt. And then each of them have subclasses. You're right, like inside private equity, there's venture. There's also venture and private credit, right? And then there's real estate and private, all those things are complicated. It's not that important, but just to understand it was really important for us to clearly define what we're investing in. Because even real estate, the terminology, I'm a real estate investor. What does that mean? Like, a flipper is a real estate investor, short-term rental, long-term rental. If I'm a passive investor, as an LP, am I a real estate investor? If I hold a REIT, a publicly traded REIT, am I a real estate investor? I think the answer is yes. These are all real estate investors, different levels of risk, return, and liquidity, and passiveness as well. Anyway, so when I invest now in the private equity space, which is more hard assets like real estate and all that world, I want to make sure I'm investing with the asset manager itself, the person who's going and sourcing the deals, raising the capital, signing off on the loans, and operating the deal. And operating doesn't mean they're cleaning the hallways of the property, but they have a property management under them, and they call the shots.
Like the asset manager.
Yeah, I mean, yes, the asset manager. That's also vague today. Like, I mean, if I'm a fund of funds that's investing in other asset managers, the fund of funds is also an asset manager.
Fair.
Right? So it's just, it's not that important just to understand what you're doing, I think. And as long as people understand what they're doing, that's fine. It took us time to understand what we're doing. I want to make sure I'm investing with the actual asset manager, the person who's calling the shots. And not the one who's just creating a joint venture and just raising capital for that person who's calling the shots. Might be getting cut of the equity, or might also be participating in calling the shots, but they don't have the majority in them. That was like the number one, like, mind-blowing moment for us to understand that. And then there's more nitty-gritty in like the deal terms and stuff like that. What a pref means, and what makes sense, and what a waterfall is, and what makes sense, and investing in newer operators versus more experienced operators, and the risks involved in that, and what you expect. Like, if I'm investing with a newer operator, like, you might be investing with someone who's been doing single-family rental properties for the past 20 years, like really understands real estate, has never raised $1 in their life for a multifamily deal, but they think they have a ton of experience. So they go and they find this deal and they raise capital, and then they have a 6% pref and 50-50 split afterwards because they have experience. Like, I think it's like, that's for me, that's a red flag. I'd never invest with that, because it doesn't. I'm not even saying if someone had 20 years of multifamily experience, I'd invest like that, but just like understanding what it means to have experience and what I'm willing to pay for that experience from a premium perspective.
I'd love to pull on that thread a little bit. I think, I think different investors look at experience differently. And this all kind of goes back to, everyone asks, like, how do I do due diligence? And like, what should I be looking for? And I think it's coming up, first understanding the landscape of who are all the players, and have they never raised a fund before, but they've done it all personally with their own money? Some investors are willing to take that risk, just like some investors are willing to be the first check into a startup,
yeah.
Right? And they're betting on the jockey. And there are other investors, I think myself in this category is, no, I think that managing investor capital is an entirely different skill that needs to be in addition to knowing how to run an asset. And so I will only invest with people who've shown track records of managing other people's money. And so I think I'm of the mindset where before you make these investments, you need to understand what is your niche that you're playing in. I like to play institutional. Some people like to do sooner. Some people are like, I don't care, it just depends on the deal. I don't think that's taking enough into account of the risks that they're taking when they look at and go into these deals. Thoughts on that?
No, I agree. Listen, this is so important for anything. Like, everything is a risk calculated decision, right? You have to take all the risks involved, and for you to take the risk, you have to understand
what the risks
are, right? So 100% I agree. I mean, and I think, listen, if you do get a deal with a first-time operator who's never raised capital before, but these guys are like young, hungry, and are going to go all in when, like, they'll sell their house before they lose investor money. I think that there's risk in that, but if the return or the terms are set to incorporate that risk, again, I think it's a question that needs to be asked, right? But I mean, sometimes I personally prefer that, like, because again, I'm looking for the upside. I'm looking for, like, all right, how do I create alpha? And so I'm willing to take that risk as long as it makes sense for me.
So I think good discussion for people to listen into, to eavesdrop into. I'd love to dig into more of that, because I like to think of myself as Strong Opinions Weekly Health. I'm kind of more on the institutional side, going with larger players, and you're talking about taking that risk with someone who's willing to not lose investor capital because they're earlier in their career. So talk to me more about maybe why or some of the maybe key things of why you feel that way.
Well, I'll flip it around for a second. I'll say I think there's risk involved in the larger players that many people do not take into account. So when you invest in institutional grade operators who have a ton of experience, number one, the terms usually reflect that. The preps, the splits, I'm not going to say they're 50-50, but usually they're not as like LP friendly as lower. The second thing I think these big operators, they have a lot of overhead. They have a huge operation. They have a lot of overhead. They have a lot of mouths to feed, and they do a lot of deals.
And they need to keep doing deals even in down markets.
Exactly. And when you do a lot of deals, it's a numbers game. Some of these deals fail. Now, if you're doing one-off deals with these operators, it's higher risk than doing a fund with these operators, right? Because they do whatever, a deal a month. There's 12 deals a year. Like one of these deals is going to go under. Like just statistically, like they can't hit. They don't know one has a perfect batting average, right? They're gonna fail at some point. That's okay. Like you invest knowing that there's a risk. I just think the reward should be equivalent, and so the more they do, some people find themselves in bad deals. The second thing is usually these big operators have hundreds, if not thousands, of investors. They can't care for every single investor, whereas the smaller operators have 10, 50 investors. Like these are people they personally know. For them to pick up the phone, the owner, the manager, and say, "Hey guys, listen, this deal went south." Whereas the big guys, they're going to have one of their IR teams call, sorry, but this is what, risk involved.
And they're more ruthless.
And then on top of all that, and I'll add another factor, which is, I think the bigger operators need larger deals. Larger deals don't always have as much meat on the bone as smaller deals, right? A big operator is going to go take a $50 million multifamily. A small operator can take a $2 million multifamily. Usually a $2 million multifamily has more meat from a percentage standpoint than a $50 million one.
Because the bigger players can't deploy enough capital for it to make sense.
Exactly. So I'm just saying there is a risk involved with the bigger operators that people just don't take into account. But I think people should just, and I'm not saying which is good and which is bad. Like everyone has their own appetite for risk. I'm just saying that you need to understand it.
And so your thesis is by going just by dynamics of how the market works, by going with smaller operators, there's a higher chance of alpha, and that's really what you're chasing.
With the risk that involved in that, personally.
Insightful, fascinating. I love that. I always love hearing how other investors think.
If you tell me there's a 11 to 13% IRR deal, I mean, unless it's a debt fund, like it's not interesting,
right?
I mean, not interesting in the sense where I want to be interested in the deal. Just from a return perspective, it's just like, I mean, if I'll put it in a debt fund, it'll get the lower risk, same type of returns. Why would I want to put it in an equity deal?
Right. Yeah, I get that. Cool. So, thanks for sharing that. That was I love that part. I'd love to dig into now of the data and insights that you have running Visor. You mentioned that you track over $18 billion across 3,500 plus investors and 600 operators, and that leads to having some unique insights just by collecting all of that. Some of which I have notes here, which may or may not be kind of what we dive into, but some of the trends, maybe we'd start with the first one, is that over the last year, according to investors that manage their assets through your platform, cash dropped by 30% over the last year. That's a big shift. Maybe investing before or after the election. I don't know. Do you have insights into that? Maybe why? Or are there other stats that are more intriguing or helpful to the LP investor who's listening?
So I think when there's inflation people don't like sitting on cash. They need to deploy it. They'll find ways. They'll find accounts or investments or other types of vehicles where they can place cash that will generate some sort of either risky or non-risk return without it being just cash. That's like when you see it's not us. That's general. Like I mean, there's not. Just, I think the reason of the decrease in cash is because of that. I don't think it's because of going into more assets than it was before. Although it might be the case because we do see an increase in specific asset classes, but we also see a decrease in some. So it's really hard to tell. Also, when you look at for example, we'll get to this, maybe crypto. Crypto went up. That doesn't necessarily mean that people bought more crypto. Just I think crypto doubled in value from an allocation perspective, from like 1.8% to almost 4% of someone's portfolio, people of our overall portfolio, and that's because crypto doubled, right? Not because people bought more. So anyway, I don't have any specific insight into the cash why it went down. But I think the other asset classes like real estate obviously went up more towards the end of the year because people were starting to deploy more capital. But when you look and unpack real estate, it did not go into multifamily. It went into other asset classes. A lot went into industrial and surprising into office as well. But not a lot into residential multifamily or commercial multifamily real estate. And I don't know if you have this in your data, but like private credit went up as well. Again, because you can get really nice returns at low risk and obviously beating the inflation in private credit.
And beating money markets. Money market at 5%, you maybe invest in like a 9, 10, 11% debt fund.
Yeah, well, money market for us is in cash accounts, same thing.
Okay.
So, yeah, because it's like 100, it's pretty liquid.
It's pretty liquid.
Yeah. And I mean, overall, like what you see is also a transition over the past year to people buying up cash flowing businesses, which is, over the years has been gaining more and more traction and it's trending. And I think it makes sense because these are actual businesses that are generating income, and there's a whole world of transfer of wealth, the $80 trillion of transfer, whatever. And that's because all these private businesses that are all mom and pop businesses that want to sell to the next generation, or they don't have a next generation, so people buy them up. And when you don't have multifamily, which was the biggest asset class probably over the past 8 years before COVID, when you don't have that, then people have to allocate their money somewhere.
Do you feel like now that you've had this insight or that you just kind of have this access, has that shaped how you think about investing moving forward, or do you look at other asset classes more or less based on trends? Does that influence your thinking at all, or how you play the game?
100%. I can't ignore it. Like, this is the data that we have, this huge aggregated data set. I can't ignore what the trends are, and because I'm I don't know if I'm a good or bad investor, but I'm an investor at heart and an entrepreneur, risk taker as well. Like, I always look for opportunities, and this is a great way to see opportunities, right? And so I definitely try to adapt my strategy to what we're seeing in the market. We also try to help all of our clients and users and to try and do the same. The time will tell if it's smart or not smart.
Yeah,
because there's a problem with herd mentality, and it can either, I don't know. I don't know if it's a good thing or a bad thing. Always to ride the wave. You might be too late to it, and then you're on the tailwinds of it, and you might already have lost. I remember in Bitcoin, for example, like me and my girlfriend bought Bitcoin, I think in 2016 or 17. I remember it was like $2,600. We had this, friend of ours was like, for a year and a half buying this, you gotta buy Bitcoin. We're like, all right, we're already too late anyway. Where's it gonna go from here? And so we thought we were after it all already. It's like, you never know how to time it.
Yeah. I know that one of the things that you're exploring and digging into now as a platform is offering investors on your platform access to kind of unique opportunities that don't exist elsewhere. Can you shed a little bit of light on that? I know that you recently did a raise, where you had an opportunity where you aggregated a couple different funds. Can you talk a little bit about that?
Yeah, so we've been like all of our users and clients over the years have asked us, hey, can you give us insight? Where are the good operators? Where are the good platforms? Like, what are you seeing? And a few months ago, we said, hey, why don't we just tap into that? Like, we can bring a ton of value. The only reason we haven't been doing this is that we want to always create a situation we have no conflict of interest. We're only like, what's in the best interest of our user base, and then pitching anything that doesn't make any sense. But then we looked in our data set and we said, with the really good GPs and platforms that we see on our platform that people probably have never heard about before, why don't we bring them and have them pitch, and we'll back it with just the data we have. And even more than, what if we can also be more valuable, we'll put together our own SPVs, our own vehicles to lower the minimums and get better terms. Like, that's a win-win-win. We don't get compensated ever by these GPs. We only want to bring value to our investor base, basically the LPs. And so we started to tap into that and see if it works. And we've gotten a lot of traction with that. We've just been bringing really good operators back in with data. We also have been bringing operators that we don't have data about, but it's the access play. So we have this one private equity fund, which is a fund of funds that is creating the first P index. So basically they have created an index of the largest private equity firms in the world, which usually to invest in them, you have to write a check ticket between $10 to $25 million. And they create a vehicle where you can write $1 million check. Now, most people even don't want to write $1 million check, so why don't we collaborate with them and we create a $100,000 minimum and partner with them and just provide access. It's a little more complicated because, again, when you look at our market, like, this is a private equity fund of funds that has capital calls by definition, like I mentioned before, like a good type of capital calls over 5 years, and they're probably not going to call all of the capital. So it's a different kind of product, but it's really interesting and unique in a way where you can't really get access to these types of opportunities without writing a lot of money, like a large check. Anyway, so we've been doing more of that, and I think it's like that has uncovered a whole world that leveraging large language models and AI to analyze data and analyze deals and to give insight into the risks and the opportunities involved in these. This is a super interesting world to be in, because the private markets is like one of the. It's funny. My last business, and we said it's not relevant, but it kind of is. One of the biggest issues in the diamond industry was opacity. People don't really know. There's no transparency. There was no transparency. What we did in the diamond industry, we created 3D imagery where you can photograph diamonds, highest resolution possible, and put them online so that people couldn't see everything within the diamond. Just creating a lot of transparency. And it just corrupted the way diamonds are traded. Every diamond today is with our tech. And now in this world of private markets, like, we're trying to do basically something very similar where we're trying to create more transparency in this very opaque world of private markets, where people think about the top 100, the Carlyles, the Apollos, the Blackstones, the BlackRock. That's PE. But the truth is, there are about 50,000 other of these private equity firms in the US that people know nothing about. Like, mid, low tier, like billion, multi-billion dollars or less. No, like DLP, like
most people don't know.
The average American doesn't know what DLP is. In our world, everyone knows who DLP is. But why can't we educate what them and, again, the tens of thousands of others are, not by what they say they are, but what other investors who invested with them say and see what they actually are. And I think that just brings a lot of transparency to the market. It is extremely hard to do, but that's sort of like our mission is to sort of disrupt that.
I feel as though this private market is very fragmented, I like to think of it similar to the real estate agent market. There's a lot of different people who are selling houses versus selling investments. It's done by trust. Oh, I know my real estate broker. Oh, I know this real estate GP. And you really don't know how the rest of the market works. And I'm wondering, How does that change, right? I mean, I think there are platforms like Visor. There are platforms that are coming out like Invest Clearly, where investors can write reviews on investments they've been in that are starting to get verified. I think is a cool trend. I think, I wish there was a little bit of a crunch base for this industry. Where it tracks. Okay, this operator has done these deals. It's public information instead of it all being very private, and it's hard to know. Are the returns that the operator says they have, are they legit? How much did they actually improve the property, or how much were the returns promoted through lowering interest rates? Things like that, I think, are ripe for someone to come in and take. How do you see that changing?
Yeah, 100%. Listen, when we started with this deal flow, we wanted to create a bunch more, like a lot more data sources to back our data and complement it with other data sources to say, this is a good operator, not just because of our data set, but because of others. And there's a few companies out there like Crunchbase and PitchBook and Preqin and some other of these like private market data insights. But like you said, they don't we asked one of these deals, we asked Preqin for, give us such like a teaser, like one of these operators. And the data they have is like basically nothing. Because it's not public. Where is all this data is in people's spreadsheets. That's where it is. Or in the LP portals that, whatever. And so we're trying to aggregate it all to create that, essentially that Crunchbase for the private markets, for this mid-low tier private market investment class, I think. And like I mentioned, I think it'll probably be a joint effort with, Invest Clear is a great platform, and some others who have tried to create different rankings and transparency in the market. It has to be a joint effort. It's just so hard to aggregate that data. It's also, there's a whole other world within this where you can't just depend on one source. And I'll give an example, because one of the things we see is a GP will update on their portal a distribution, or you'll get an email about a distribution. But actually what you get in your bank account is a different amount.
This was actually an example that I did some research on and wanted you to talk about. So I'm excited you're digging into it.
It's crazy. Like, you never imagine, and you think this is like a one-off mistakes, but this happens a lot, where GPs notify an LP, and because everyone makes mistakes. Like, they're not scamming or lying. They just, send a notification, hey, this quarter you're getting a $10,000 distribution. But in your bank, you get 1,000. Like, hey, what the? Now, most people don't even go and cross-reference it. Like, all right, whatever, well, fine. Or they look in their bank and they don't even know where that's from. Like, we do that cross-referencing, and we identify this a lot, where GPs make mistakes. And GPs will say this also, sometimes we make mistakes. It's hard. It's hard to sort of follow up on distribution and to send K1s on time and prepare everything at par. And so I think to have the ability to really rank these GPs properly, you have to have multiple data sources, because we link in our users' bank accounts, and we reconcile all their transactions and link transactions to specific assets. And then we also are linked into the investor portal, and so we pull data from the portal, and then we cross-reference those. And if it doesn't match, we raise a flag. So there's all these things that need to be done in order to be able to vet and rank these operators properly.
And I'm just trying to think through what those things include. I imagine if there's a way to track communication, if there's a way to track K1s being shipped out properly on time, are these distributions hold up to pro formas?
There's a lot. I mean, even that, when you think about it, and we talk about this also in a lot of our groups, the groups we're part of, right? There are situations where GPs stop distributions. It sucks.
And it's normal.
It happens. And I measure the people I've invested with on what is the level of communication that they can use to communicate with me around this change of plan. It might be a good thing because they're protecting themselves from what's coming, and so they want to make sure they're in a good cash position, and they keep LPs in the loop. Whereas there are GPs that we also know about that they just ghost you, off the face of the earth. What the hell would happen? We were good friends. What did you get? That happens as well. So, there's distributions, then there's performer versus actual. There's also, the basic, how many people have invested with this person, and how many have done more than one or two or three investments. that also shows a level of credibility. Because if everyone only invested once, but nobody reinvested, that's a red flag.
Yeah, percent of repeat investors.
Right? And yeah, I mean, there's a lot. And you can't really depend on what the GP tells you.
Have there been, I mean, you've been in this game for 10 years now.
Mm-hmm.
I imagine the way that you said it yourself, and all of us, right? Like you learn best by playing the game. And it's hard to know everything up front before you invest. What's changed, or what are non-negotiables or questions that you ask now that are part of your process, or are immediate red flags, or things that you care about that you might not have when you started?
Yeah, so first of all, now I think that the GPs who are going through this current phase, people that are raising capital now and doing deals now, this is a really interesting time to do deals. Just because there are opportunities to be made, and these are like people that, if they can make things work now, then they'll make it work also when times are easier. For me, the question, we talked about this at the beginning in terms of like who I'm investing with. I might invest with a capital raiser only if I think I'm getting better terms. In these deals where there's a refinance component to them, this is more equity plays. I always ask the question that I got not burned, but we went through one of the deals we invested in. Like we invested, I think, $50,000, and after 2 years, there was a refinance event where we got a large part of it back, not all of it. I think probably 35,000 back out of the 50. And then the distributions were based on the remaining capital. So based on the remaining 15. And then like 6 months later, we got the 15 back as well. And from then until this day, which I'm still in the deal, it's been probably 8 years since then. I think this is the first or second or third deal we did. The distributions are still based on the last remaining capital I had.
So, what do you mean by that?
So, whatever. There was a 7% pref, okay?
Okay.
The beginning, and that was also the cash on cash distribution. So the 7% was on 50,000 at the beginning.
Right.
Then I get 35,000 back. Now the pref is not on the 50, it's on the 15 remaining. 1.5.
Because it's based on how the PPM was written.
Well, yeah, I didn't read it. Honestly, I didn't read it well.
Yeah. Or understand the difference.
Yeah. Well, here's the thing. Yes, this is now a question I asked, and a lot of GPs I asked, or the IR team, they don't always know how to answer this question. Because I frame it exactly in that situation. Like, what do you do? Because people don't ask that question because people don't think about it. Because then I got the 15 remaining back, but the 7% was now still, they didn't kick the waterfall in place. Like nothing happened. I kept on for 8 years. I'm getting distributions on $15,000, which there's no way the property isn't performing more than that they can split more. Like why you distribute?
So you're basically getting a smaller distribution.
I'm just getting a smaller distribution, whereas I should be getting probably a bigger one. Anyway, but that's the point. It's not a bad deal. I mean, the deal's okay. I got all my capital back. Now I'm just getting money on infinite whatever.
The dream.
Yeah. The fact is now when I go and I invest with a GP that has some sort of refinance in their plans, well, what happens in this scenario? What happens? I give you write $100,000 check. You're paying me $8,000 every year. A year later, you give me $80,000 back because of refi. I have 20 now remaining in, right? What are you paying me the 8% on? Usually they'll say, well, I didn't think about it, or I don't know, or we're paying on the 100. Wait, you sure you're paying on the? They don't, it just makes them think, and they don't have that answer. And then I see how they respond to me, and they go check, they get back to me. For me, I want to see that the waterfall kicks in. That's what the answer I want to see that in the PPM. I want the waterfall to kick in, right? That's what the answer I want to hear. But I also want to see how they respond to that type of question.
I'm envisioning the LPs listening to this and writing down their hopefully their 100-point deal research checklist. The additional question to ask: what happens after a refi? How does the prep work?
Yeah. And we also have been doing so also me and 2 other LPs, Mike Herndorfer and Hans Box, we all started this podcast where we have GPs send us their pitch decks. We publicly review them and we go over this type of stuff there as well. And it's crazy what you see in these decks. they're clearly built for people who, or a lot of them have been built for people who are like really non-sophisticated. I hope GPs level up their game and LPs come smarter to these deals and ask better questions.
That's what no. It's not a hope. That is what we are doing right now. We are leading the movement of setting the standard of what needs to be asked and requested from GPs. And it is going to force GPs, for all those GPs listening, this is good for you as well, to step up your game. Because the more transparency and the more open book all these things are, I think it only benefits the entire community.
100%. And I think leveraging, the tech stack that is currently in the market is only a teaser of what's going to come. Like we've tapped into all these language models and built our own AIs to analyze deals, to supply GPs with a better tech stack to present their deals in a way. Like we started to do something recently where because we put together these deals with these GPs, we said, all right, why don't we take all the data that we have, teach a model how to understand a deal, teach it how to interact with people, like being the best investment relations you can be, and then package that up as an AI bot where the GP can now send a link to any prospective investor and have them ask any question they want about the deal. And just like interacting with an AI. That's the future where we're going with this, right? At the end of the day, both for the asset management side of analyzing stuff to the LP side of analyzing stuff to just understanding more data faster. So obviously we need to educate ourselves as LPs, but also we need to know how to leverage technology to help us do that better.
Yeah, I think that's an interesting vision, and I don't disagree. I think most people want to try and do as much research as they can before getting on a phone with a GP. I know that myself. Every GP, every operator, when you talk to them, immediately wants to get you on the phone. I get why. They want to build that relationship, and to me, I'm the first person that says no, but can you send me a deck so I can look through this and get an initial feel for if this is even interesting to me to spend half an hour with you. I think...
And you're a sophisticated investor, right? I think,
you're giving me a lot of credit, but...
No, but seriously, when you look, I think, at people that are just getting started, I feel like a lot of times they don't even know what questions to ask. And so they want to think, they're going to consult with other people. Like, I'm getting on a call with this GP, what should I ask?
Yeah.
Like, they want to feel like they're asking smart questions and not stupid questions because they need to justify for themselves why they should invest in this deal. Because a lot of these first-timer LPs or beginner LPs, I think the biggest problem is they get stuck in analysis paralysis, right?
Well, they don't know what they don't know. Right. And we've all been there.
Yeah, no, 100%.
But I think what's fascinating about the vision of the future is, how will asking GPs these nuanced or tough questions change? Because I actually think that seeing the operator answer either with, I don't know, let me get back to you, or we don't share that with LPs, or watching them squirm. It's an interview, and how does that change or get replaced as we have more of this type of technology?
That's a good point. The thing is, you're giving a lot of credit to investor relations and their effect on the actual deal and the asset management capabilities of the deal. Because I'd agree if you're talking directly with the managing partners of this GP, I agree 100%. And yeah, the IR does say something to how the fund operates, but I don't necessarily think that is like the key in making a decision of like if the IR might be new. Like, I don't know. I'm just saying that I agree. If I would want to talk with the managers, which is not scalable for their side. Because here's the thing: when you're talking with an IR, and
investor relations person, investor relations,
and they're this amazing salesman, like a slick salesman, like that also says something. I'm not sure if I want to. So it's really tricky.
You clearly haven't invested with Grant Cardone. I have.
Okay.
He's got almost, and I actually think it's incredibly impressive. There are some people turned off by that, but
Well, I have not invested with crypto, but I want to hear more. I don't know if we can do it offline or not, but I want to hear more about that. But anyway, yeah, it's a hard first step to take, to write that first $50,000 check, and no matter how much you get ready for it, there's so much people will learn after writing it. Like, you will never be 100% prepared to write that check. It's like you're never going to be 100% ready, and this is maybe not the great anecdote, but you're never going to be 100% ready to get married. Or 100% ready to have kids. Like, waiting for the 100% is never going to happen. People who think that they're going to reach that level of certainty is just, they're misleading themselves.
I do think, and I'm going to do a shameless plug because I think I wish this existed when I started. There are, just like before getting married, you can talk to an attorney, and you can go through the process of prenup and like really understand what is the legal part of getting married look like, and we've now put together a program. We're actually working with Best Ever trying to figure out how to bring it to the group, but have this program called Cash Flow Academy where I help people, at least give them the framework that I use to put together a macro plan of what am I trying to achieve, what is the investment thesis I'm going after, and then what is the process I go through to compare a bunch of different deals based on my thesis, and what are the 100 questions that I'm asking to make sure no stone is unturned. So I think whether it's that or even just, if you just take the framework I just talked about, before you invest in your first deal, having some sort of plan about what you're doing, I think is I just wish more of that existed.
Totally. That's so important. But even that, it's giving people the confidence in their decisions and understanding the risk involved. And understand there is no 100%. Like, there's a checklist. I want to make sure that I can live with all this
and
stuff.
The point is not figuring out, is this a good or a bad deal? It's, how do I reduce the risk and go into this investment eyes wide open?
100, yeah, exactly. I agree.
Litan, this was a super fun conversation. Really enjoyed it. Thank you for sharing what you know with our LP audience. Where can people find more about Visor and learn more about you?
Thanks for having me on the show.
Yeah.
Appreciate it. I'm pretty available on all social media. Litan Yahav, Litan Advisor, VYZER.co. Always love talking with you and other passive investors.
Love it. Thanks so much, man. For those of you listening, if you are looking to stay ahead of the curve and make smarter investment decisions, make sure you join on Thursdays. This Thursday, every Thursday, I'm hosting the Passive Income Playbook. If you enjoy the show, please be sure to leave us a review. All those reviews help us reach more LP investors like you and bring on amazing guests. So thank you so much for joining us, and I will see you next week for the Passive Income Playbook on the Best Ever CRE Show.